I'm the Tax Geek, and this is your taxes oversimplified. Today, it's the great debate: married filing joint versus married filing separate. First of all, let's go over the tax law as it exists for married people. The IRS considers you to be married if you possess a valid marriage license. In certain states, you can also be considered married under common law. Contrary to popular myth, if a man and woman live together for more than 7 years, they are not considered married under the common law. In most states that recognize common law marriage, a man and a woman must openly cohabitate and present themselves to the world as a married couple. In any case, your marital status for the year is determined by your marital status as of the last day of the year. Get married on New Year's Eve, you are considered to be married for the entire year. Now, once you possess a marriage license or are considered married under the common law, you must file as a married person as long as you are married. If couples separate and live apart from one another with no legal paperwork, they cannot simply start filing returns as single people, though one spouse may file as head of household, but that's a story for another video. In short, while there may be such a thing as common law marriage, there is absolutely no such thing as common law divorce. You are also considered married for tax purposes if your spouse dies during the year, and again, you must file as a married person. So that being settled, do you file jointly or separately? When couples file jointly, they combine all their income, deductions, and credits onto a single tax return. Each spouse can then be held responsible for the couple's total tax liability. All couples can file jointly, even if only one spouse had income. When couples file separately, they each report their own income, deductions, and credits on separate returns. Each spouse can only then be held responsible for their own taxes and not the other spouse's. At least this is how it works in states that are not community property states. For more information regarding separately filed returns in community property states, there are links to resources in the description. So what is better, filing jointly or separately? As with just about anything with regard to taxes, it depends. However, the general rule is that the grand majority of couples pay less tax as a couple if they file jointly. Here is a partial list of tax benefits that are not available to married couples filing separate returns. The Earned Income Credit, Credit for Child and Dependent Care, American Opportunity Credit and Lifetime Learning Credit, the Premium Tax Credit, the Student Loan Interest Deduction, the Tuition and Fees Deduction, and deductibility of mortgage insurance premiums. In addition, when couples file separately, the tax brackets are more compressed, usually resulting in higher taxes. If one spouse itemizes deductions, the other must itemize, even if the other spouse has little or no expenses to itemize. Filing separately greatly reduces the amount that can be deducted for a traditional IRA contribution and also reduces the amount that can be contributed to a Roth IRA. Get it? The IRS really doesn't want couples to file separately. So why do people want to do it? Some couples really don't want to mix finances. They're willing to accept higher individual tax liabilities in exchange for keeping their finances separate from each other. Some couples don't know any better. They might have heard from a friend of a friend somewhere where couples can save on taxes if they file separately. And yes, they can under very specific circumstances, but these circumstances rarely apply. Sometimes couples have to report income on individual returns to qualify for financial aid or student loan forbearance. And some couples need to separate their tax liabilities because one spouse has back state or federal income taxes, a student loan in default, or owes back child support. When these couples file jointly, the IRS will take the couple's entire refund and apply it to the back debt. In this last case, there is a way for couples to file jointly, preserve their tax benefits, and not have their entire refund applied to the back debt. Couples in this situation can file Form 8379, the Injured Spouse Allocation. This form allows a couple to file jointly and allocate income, withholding, and tax benefits between them. This form can be filed with the tax return, or it can be filed afterward if a refund has been confiscated. The injured spouse is the spouse that is not liable for the back debts. Also, please don't confuse this form with Form 8857, Innocent Spouse Relief. That is an entirely different situation and a story for another day. The first page of Form 8379 is a checklist to see if the spouse in question qualifies as an injured spouse. On the second page of the form, the couple proposes to the IRS how they would like income, deductions, and credits to be allocated to each spouse. If the IRS accepts the couple's proposals, they will allocate part of the refund to the injured spouse and apply the remaining part to the other spouse's back debt. As with everything taxes, there are many additional nuances to this topic. There are links to additional resources in the video description if you'd like more information. If you found this video informative, please give it a thumbs up and subscribe to see more content like this. If you have any questions, comments, or suggestions for future videos, please leave them in the comment space below. Thanks for watching, and stay tuned for more oversimplified information about your taxes.